Tax the rich. 3 words that have become one of the loudest political slogans in America. It sounds simple. The rich have enormous fortunes. The government needs money. So, tax the rich. Problem solved. Except there's a problem with that argument. The math. Because taxing wealthy Americans can raise substantial revenue. It can reduce inequality. It can close loopholes. And there are perfectly legitimate arguments for doing all of those things. But if the goal is to rescue the United States from its enormous and growing fiscal problem, tax the rich is not enough. And understanding why requires looking beyond the slogan. Let's start with something important. The anger behind tax the rich isn't imaginary. America's tax system contains provisions that disproportionately benefit people with sophisticated financial structures and expensive advisors. There are preferential rules for different kinds of investment income. There are complicated estate planning strategies. There are offshore structures. There is the stepped-up basis at death. There is carried interest. And because wealthy people have more resources to devote to tax planning, they can often structure their finances in ways ordinary wage earners simply cannot. That is a legitimate policy debate. But here is where the argument gets complicated. Wealth is not the same thing as cash, and this distinction is absolutely crucial. Take America's billionaires. Forbes counted 989 US billionaires in 2026, with a combined fortune that was vastly larger than the $6.6 trillion figure often used in older arguments about confiscating billionaire wealth. But let's use the basic thought experiment anyway. Suppose the government could somehow take everything owned by America's billionaires. Their companies, their stocks, their real estate, their private investments, their yachts, their jets, their art, everything. Sounds like an enormous pile of money. But there's a catch. Most billionaire wealth isn't sitting in a bank account. Elon Musk's fortune, for example, is largely tied to ownership stakes in companies. The same basic principle applies to people like Mark Zuckerberg, Larry Ellison, and other billionaire founders. Their net worth is largely the market value of assets they own. So imagine the government suddenly says, "Okay, we're taking it. What happens next?" Those assets have to be transferred, sold, or otherwise converted into something the government can spend. And if the government attempted to dump enormous quantities of publicly traded stock onto the market, prices could fall. That means the government couldn't simply take today's quoted market value and assume it would receive exactly that amount in cash. This is one reason why billionaire wealth is difficult to treat like a giant checking account. A fortune on paper is not the same thing as a pile of spendable dollars. And there's another problem. Once you've confiscated someone's fortune, you can't confiscate the same fortune again next year. That's the fundamental limitation of a one-time wealth grab. It can raise money once. It doesn't create a permanent revenue stream. There's another uncomfortable question. Suppose the government forced billionaires to sell huge amounts of stock. Who buys it? Not the average nurse, not the school teacher, not the construction worker, not the family saving $200 a month for retirement. The buyers would largely be other investors and financial institutions. Companies such as BlackRock, Vanguard, and State Street manage enormous pools of capital on behalf of millions of investors. So the ownership of companies could change. But that doesn't necessarily mean wealth simply travels from billionaires directly into the pockets of ordinary Americans. And this is where the slogan becomes much more complicated than it sounds. Tax policy is not a magic transfer machine. You have to ask, how much money is actually collected? How does the tax affect investment? How do asset prices respond? How do people change their behavior? And, most importantly, how much revenue survives after all those reactions? This isn't purely theoretical. Countries around the world have experimented with wealth taxes. France is one of the most famous examples. For decades, France had a broad wealth tax known as the ISF. But in 2018, France replaced it with a much narrower tax focused on real estate wealth. The OECD described the reform as a significant narrowing of the tax base because financial and movable assets were removed from the wealth tax calculation. Now, here's where the story gets more interesting. People often claim that France's experience proves that wealth taxes simply cause the rich to flee. The reality is more complicated. France did experience wealthy taxpayers leaving the country, but the evidence does not support every dramatic claim made about tens of thousands of millionaires fleeing solely because of the wealth tax. In fact, French government research found that departures of wealth tax taxpayers fell sharply around the time abolition was announced. So the lesson isn't, tax the rich and everyone runs away. The real lesson is more subtle. Tax policy changes behavior. Sometimes wealthy people move. Sometimes they restructure investments. Sometimes they defer income. Sometimes they change what they own. Sometimes they simply hire better tax advisors. And governments have to account for those reactions when estimating how much revenue a tax will actually produce. Norway provides another fascinating case. Norway still has a wealth tax. And in 2022, more than 30 wealthy Norwegians, including billionaires and multimillionaires, moved abroad, many to Switzerland. Their combined wealth was reported at around 29 billion Norwegian kroner, and they had paid roughly 550 million kroner in taxes. The number of wealthy departures in 2022 was reportedly greater than the previous 13 years combined. One of the most prominent was businessman Kjell Inge Røkke, who moved to Switzerland. But again, we need to be careful. Migration doesn't prove that taxation was the only reason someone moved. People move for business, family, lifestyle, investment opportunities, political stability, and taxes. Sometimes all of them. But the broader point remains, when money and people can move, taxes can influence where they go. And that creates a problem for governments trying to tax highly mobile wealth. Some people respond, fine, that might work in Europe. But wealthy Americans can't just escape American taxes. Well, it's complicated. Puerto Rico's Act 60 provides substantial tax incentives for qualifying residents and businesses, including a 4% income tax rate for certain eligible business activities and significant exemptions for qualifying investment income. And unlike moving to another country, moving to Puerto Rico doesn't require giving up U.S. citizenship. That doesn't mean every billionaire can simply move there and pay 4% on everything. They can't. The rules are much more specific than that. But the example demonstrates an important principle. Tax competition exists inside the United States too. And when the tax system changes, wealthy people have incentives to search for better ways to structure their affairs. Now we reach one of the most repeated arguments in American politics. The 1950s. The top federal income tax rate reached 91%. And America was booming. So shouldn't we simply go back? Not so fast. First, that 91% was a marginal rate. It did not mean a wealthy American handed 91% of their entire income to the federal government. The highest rate applied only to income within the highest bracket. In 1955, for example, the 91% rate applied above $200,000 for some filing categories. And very few households actually reached that bracket. Research summarized by the Tax Foundation estimates that the top 1% faced an average combined federal, state, and local tax rate of about 42% during the 1950s, not 91%. For the top 0.1%, the average effective income tax rate was estimated at around 21% in the 1950s, illustrating just how different a marginal rate is from the effective rate people actually paid. So when someone says, America taxed the rich at 91%, the correct response is yes, but that's not the same thing as saying rich Americans actually paid 91% of their income in taxes. And there's another problem with the nostalgia. America's post-war economic dominance had many causes. The United States emerged from World War II with its industrial base largely intact, while much of Europe and Asia had suffered catastrophic destruction. American factories were producing at extraordinary levels. The country had enormous industrial capacity. Pent-up consumer demand was unleashed. Infrastructure expanded. Productivity grew. The American middle class expanded. And the United States benefited from becoming the central economic and financial power of the post-war world. So it's difficult to look at one tax rate and say, that's why America was prosperous. History doesn't work that neatly. And now we arrive at the part that matters most. America doesn't simply have a taxation problem. It has a spending problem. According to the Congressional Budget Office, the federal government is projected to spend about $7.4 trillion in fiscal year 2026, while collecting roughly $5.6 trillion in revenues. That's a projected deficit of about $1.9 trillion. And the problem compounds. The national debt generates interest. That interest has become one of the largest expenses in the federal budget. According to CBO projections summarized in congressional budget materials, net interest spending is expected to exceed defense spending in the coming years. Think about that. America isn't just paying for Social Security, or Medicare, or defense, or roads, or federal agencies. It is also paying enormous amounts simply because it borrowed money in the past. And those payments don't build a new bridge. They don't educate a child. They don't invent a new technology. They don't create a hospital. They are the price of carrying yesterday's debt. Here's where the debate needs to become more intelligent. Saying tax the rich isn't automatically wrong. There are serious arguments for raising taxes on extremely wealthy households. You can debate capital gains taxation. You can debate the stepped-up basis. You can debate estate taxes. You can debate loopholes. You can debate whether billionaire fortunes should face an annual wealth tax. You can debate whether corporations and high-income households should contribute more. Those are legitimate questions. And closing loopholes can absolutely raise revenue. But here's the mistake: pretending that taxing billionaires alone can solve America's structural fiscal problem. It can't. Even very aggressive tax policies face economic and behavioral limits. And America's budget problem is measured in trillions of dollars every year. So the question isn't simply, how much can we take from the rich? The better question is, how much can the government sustainably collect, and how much is it willing to spend? Those are two completely different questions. Tax the rich is politically powerful because it identifies a very real frustration. America has enormous wealth. America has enormous inequality. And America's tax system is complicated enough that sophisticated taxpayers can often do things ordinary workers cannot. But a slogan isn't a budget. A billionaire's fortune isn't a bank account. A 91% marginal rate isn't a 91% effective rate. A wealth tax isn't guaranteed revenue. And confiscating wealth once doesn't solve a permanent annual deficit. The uncomfortable truth is that America has to confront both sides of the equation. Revenue matters. Tax fairness matters. But spending matters too. And if Washington continually spends more than it collects, raising taxes without addressing the underlying spending trajectory simply moves the problem around. So maybe the real political slogan shouldn't be, tax the rich. Maybe it should be, show me the math. Because when the numbers involve trillions of dollars, the math always gets the last word. If you made it all the way to the end, you clearly like digging beneath the headlines. Hit like and subscribe for more documentaries that follow the money, challenge the conventional wisdom, and look at the numbers behind the political slogans.